Happy Friday out there, Team 42. It's your skipper here, Darius to present our macro minute for Friday, July 25th, 2025. Hope everyone's having a great week. So, as always, we'll start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions and to see if you need to make any changes in your portfolio to remain on the right side of market risk or to get on the right side of market risk to the extent you haven't been following Kiss and Dr. Mo, you need to be a client of 42 Macro. So today's key macro question is, how will the President Trump versus Powell Fed saga play out? Our answer: if you're not fully convinced that our investing during a fourth-turning regime framework is the most profitable roadmap for navigating macro risks after yesterday's WWE/mafia-style Fed construction site visit, then you must navigate to our client dashboard today and immerse yourself in the materials. Because it is happening, whether you position for it appropriately or not. If by the end of the decade your portfolio was not A, overweight monetary debasement assets, and B, safeguarded by institutional grade risk management overlays, then there is a high likelihood that you or your client's portfolios may dramatically underperform portfolios that feature these conditions. If you or your clients want to retire on time and comfortably, and I assume you do, otherwise you wouldn't be listening to me speak, you or they must A, make a lot more money as its value gets debased by monetary support for fiscal dominance, and B, actually keep it when all hell breaks loose with increasing frequency, I might add. To this point, our crowding model just generated a bearish signal for the S&P 500. Dollar cost average into our paradigm seat party accordingly, i.e. slowly over the next month. Everyone who's well versed in history knows that every society in recorded history has reached these fourth turning style tipping points. The beauty of our American democracy is that we always get really close to the edge and find a solution before falling off the proverbial cliff. Kiss and Dr. Mo are two of our core contributions to the developing solution set. Are Kiss and Dr. Mo perfect solutions? Absolutely not. Of course not. But perfection is neither attainable nor reasonable at our generous price points. We didn't start 42 Macro to get rich. We were already rich when we started this company. We started this company to actually help people. Thank you for partnering with us and supporting our mission. We appreciate you. Transitioning to our 42 Macro dashboard. As always, we'll wrap up with the question from our community. This one's, I think it's titled Short and Long-Term Rates. Says, hi, Darius. I'm a new client of 42 Macro. I am so glad I joined. Appreciate you. Your Kiss and Dr. Mo risk management overlays are invaluable and your fundamental research and qualitative risk management tools are helping me to understand the full distribution of probable market outcomes. I am less stressed now. High five. That's amazing. Nothing makes me happier than our clients' stress levels going down as their portfolio's net asset value goes up. I think that's the general experience of the clients at our company, which is why we have a a three handle on our attrition rate, and most companies in our industry are usually in the high teens, according to our market research. So, I think we're doing exactly what we set out to do for our clients, and we're really grateful for that. Really blessed. So, getting back into the question. Your interview with Maggie Lake on Talking Markets yesterday was awesome. I do have one question as follows. You expressed the view that the Fed should lower the short-term Fed funds rate due to slowing growth in the private sector labor income and what appears to be a softening labor market. Additionally, from a structural standpoint, given the geopolitical-driven supply-demand imbalance in the Treasury bond market, the term premium demanded by investors is rising and the fair value of the 10-year Treasury note is about 5.5%. Even if the Fed lowers the Fed funds rate, there is no guarantee the rest of the curve will also decline. And in fact, the 10-year note and 30-year bond will likely rise and may have a tightening effect on credit creation and financial conditions. In addition, won't the equity market likely have a correction if the 10-year Treasury note reaches 5%? Your thoughts on these issues would be appreciated. So, big time question. This is excellent question. These are the types of questions that I've obviously been fielding from institutional investors throughout the week. And so just want to commend the new client for, the framing of which, framing this question so thoughtfully and elegantly, because again, they're touching on a lot of different things that I think we need to unpack here. So I think the starting, I think we need to sort of clear the deck chairs for a bit in terms of how the bond market usually reacts to interest rate cuts. If we saw, some form of politicized rate cutting by the Fed, or if the Fed just started cutting rates, I think those are two different outcomes. One, if the Fed just started cutting rates because enough FOMC market participants viewed the one-off price level change associated with tariffs is less of a risk to inflation as the already observable slowdown in private sector labor income is to the durability of the business cycle and their maximum employment mandate, they could all come around to that, especially if they start to see more and more deteriorating labor data in the context of our U-shaped economy. If the Fed is just cutting rates because, the labor market is telling them to cut rates, and they can look through what is very clearly not inflationary price adjustments from tariffs, this is no academic research would tell you it's inflationary. They're just anchoring on the inflation expectations genie that they let out of the bottle with bad policy. Anyway, so I don't want to diatribe too much, but if they just cut rates because, they need to cut rates, then the bond market, in terms of the interest rates, both on the 10-year and 30-year, will probably actually go down. Probably not as much as the rate cuts themselves. So you'd probably see some bull steepening of the yield curve in that context. If we saw politicized rate cuts, which is probably where we're just highly likely where we're headed at some point over the next few years, then you could easily see an adverse reaction in the bond in the long end of the treasury curve in terms of something similar to what we saw play out last fall. But I will caveat that by saying, and I'll take you to my Bloomberg launchpad here and just show you, last fall is a bit different than where we were today. If you recall, last fall, we had a over more than 100 basis point decline in the 10-year treasury yield prior to the Fed cutting interest rates. The 10-year treasury yield peaked in late April at a high of 4.74%. It declined all the way to a low in mid-September to a low of 3.6%. So we saw a 114 basis point decline in the 10-year treasury yield prior to the Fed cutting interest rates. And so we saw the Fed cut interest rates. In fact, I was on our friend Charles Payne's show this week here telling people to sell bonds because the Fed was about to cut, the rate. They had this, very narrow window to sort of sneak in a bunch of rate cuts if they wanted to. And it was probably going to extend the duration of the business cycle. And that's exactly what the bond market reacted to. The Fed got the memo, started cutting interest rates, and started to, ease policy in a way that the bond market took as a signal that the business cycle would get extended, which is exactly what we were calling for in our research in August and September. And so we saw another backup in the interest rate. I want to say we rallied from 3.6 on the 10-year to a high of 4.81 in early January. And so, in our opinion, we think that the bond market reacted appropriately. We had a growth scare. The Fed reacted to the growth scare, and then the bond market sold off as a function of the economy being much better than investors thought it was down here in August and September, when we were, again, having to defend our resilient U.S. economy theme again. How many times have we had to defend our resilient U.S. economy theme since we authored it in the summer of 2022? I mean, that was like we had to defend it then, we had to defend it then, we had to defend it then, we're defending it now. And so I just think investors need to be aware that just because of what happened last fall, you shouldn't just automatically assume that if the Fed lowers the policy rate, the 10-year and 30-year interest rates are going to go higher. That's not normal. That's not a normal dynamic. There's a thing called roll in the bond market, and so fixed income investors are they like making money. They don't like they don't like telling narratives. They like making money. And so ultimately, you could easily see the bond market rally if the Fed is cutting rates for the right reasons. Now, if they're cutting for the wrong reasons, then you could see term premium wide, and you could see inflation expectations go up, which is likely to happen. And ultimately, you're going to require some form of durable Fed yield curve control to fix that, which is where we think we're headed. We think that's ultimately the end point of this whole process. But it's not, like I said, this is going to be a multi-year process. Could be 5 to 10 years in the making in terms of the duration of this fourth turning, where we're actually using the Fed's balance sheet to help capitalize the U.S. government because we're running out of domestic and foreign creditors. And so that's been our view for the past 2 years, and KISS has obviously benefited tremendously from its orchestration and construction, primarily the risk management overlays that we feature in that. And so I think there was something from yesterday. Now I'm forgetting it again. It was a good important thought, but if I remember it for Monday, I'll bring it up then. But I just want to say thanks you again. Thanks to everyone to tuning into these macro minutes. They're obviously not a minute, but in the context of a fourth turning poly crisis, the distribution of probable economic and policy outcomes is incredibly wide. It's fantastic to be in the macro risk management business because I think people people need help. There's the most uncertain most investors have ever been in their career, and guess what? Because most investors have never risk managed through a fourth turning before, and so I think we're doing a better than bad job of helping create some level of certainty amongst our client base and amongst our community in a world that is highly uncertain from the perspective of most investors. We've been pounding the table on Paradigm C since April 23rd. We've been telling you to jump in the pool and expect the continuation of the V-shaped rally since May 3rd. And one by one, every week that goes by, we see more folks across global Wall Street, kind of adopt our view. Doesn't mean it's going to continue on in a straight line. It's not going to continue on a straight line. We're probably going to, like I said, with the crowding mouse signal, we're probably going to have some form of volatility or chop, or maybe even a correction over the next month or two. But that's fine. Market's probably not going to crash, folks. We tried Paradigm B. The bond market told them not to do Paradigm B, and now we're in Paradigm C. It could last for multiple years, if not 3 to 4 years. And so hope everyone gets that memo. Like I said, thanks again for tuning in. I want everybody to have a wonderful weekend. It's my son's first birthday party this Saturday, so obviously I'm pumped as a dad. That's it. I'll catch you back here on Monday. Cheers.